Well, actually, it's been a tough start to the year, actually, and the pressure is coming from the US on bond yields with uncertainty around the Trump policies, whether he will reignite inflation or not. And this is having global reverberations amplified by local factors such as fiscal stability concerns in the UK, political instability in France. So we think the year will be quite tough. We think the volatility regime will be higher with considering the valuation of US equities and these sources of uncertainty, the unpredictability of Trump. So we think the markets will be quite shaky in 25, but we think the trend will remain higher.
Philippe, rich valuations versus higher yields. I mean, that was the equation we got down to this week, and it felt as though it's been a week of two halves. We started at the week with everybody again talking about the overweight to the US because of the growth prospects, even though valuations are fairly rich. Second part of this week, investors have rolled over to look at the bond market and what those higher borrowing costs could bring and whether we're overvalued now in terms of some of those US trades. How are you thinking about whether you can still extract value out of US stocks this year?
Well, actually, the US economy is growing strongly. 3% growth rate plus 3% inflation means that earnings growth will be in the area of 15% up this year. So the US economy remains rock solid. There are concerns about valuation, about bond yields, but the fact is that the fundamentals remain strong. The consumers continue to spend in the US and elsewhere. It's not an easy place. Europe is more into political and low growth concerns. Asia and China facing its own challenges. So the opportunity set outside the US is overall quite limited.
Philippe, very good morning to you, sir. Are blue chip equities that have strong cash flow and a strong profit profile more defensive now than treasuries?
Well, yes, actually, the risk profile of equities versus bonds, historically, equities have been the risky asset, bonds the safe asset. But this has changed in the past 2-3 years with the inflation surge, with, fiscal stability concerns. Yes, indeed, equities appear now safer than bond yields, and companies with strong balance sheet and strong profitability are actually safer than many sovereign issuers.